A gush of capital from emerging markets during the past 13 months has almost topped $1 trillion, raising concerns that emerging market economies are no longer drivers of global growth. With me to discuss this is James Kynge, our emerging markets editor. James, why is this significant now? How does it compare to before?
I think what's significant about this is that the outflow of capital, which, as you said, has reached about $1 trillion over the last 13 months, is now double the levels of the capital outflow that we saw during the 2008-2009 crisis. So clearly this is a big issue. What's important about this is that it's a symptom of the fact that emerging markets, which used to be one of the most dynamic aspects of the global economy, a locomotive for global demand, are now badly sputtering.
Okay, so what's causing it?
What's causing the capital outflows is a number of different factors. First of all, China. China is experiencing big capital outflows itself, but also Chinese demand, as its economy is slow, for things like commodities in many parts of the emerging world, Latin America, Africa, etc., is waning sharply. That's driving emerging market currencies lower, and that is helping to cause this outflow of capital from these emerging markets.
And other factors?
Other factors include the Fed. The US Federal Reserve is expected to raise interest rates sometime later this year, and that means that people expect the dollar to strengthen against emerging market currencies, which means that people don't want to hold assets in those emerging market currencies as much as they did before. Therefore, they sell those assets and capital flows out of their countries.
So to what extent is this going to get worse? 1 trillion over 13 months. Is there a lot more of capital to flow out? Presumably there is.
The interesting thing is that about $2 trillion in capital flowed into emerging markets in the 6 years after the 2008 crisis. So if 1 trillion has flowed out already, then it's quite possible that we've got quite a lot more capital to flow out. In fact, many analysts think that we've only just begun this process and emerging markets could be increasingly impaired by this process.
So, look, is this a crisis? I mean, how does this compare to previous financial turmoil for emerging markets?
We're not calling this a crisis yet. And the reason for that is I think that it's happening in slow motion. The previous crisis that we had, 2008, 2009, that was a sudden and, for emerging markets, an external shock. The Asian crisis at the end of the 90s was also a very sudden episode. But this has been happening slowly over many months. Capital has been flowing out, GDP growth in emerging markets has been slowing, import demand in emerging markets is down about 13% year on year. So this is something that's playing out in a much more slow motion process. But the problem is we don't know when it's going to end, and the pain that emerging markets are inflicting on themselves and the rest of the world is mounting steadily.
Yes, and I presume the toolbox for policymakers is virtually empty. What, if anything, can central bank policymakers or governments do to arrest this?
It's a good question. Some people are even beginning to say that the emerging market growth model is broken. This growth model in which they relied on exports to drive domestic growth, building up their reserves, etc., is now broken. And some people are beginning to suggest that the only way out for emerging markets now is to spend a lot more fiscally, fiscal pump priming of their economy, spending on things like infrastructure, etc.
James, thank you very much indeed.
Thank you.